Good morning and welcome to the TR Property Investment Trust PLC Investor Update. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll. And I would now like to hand you over to Marcus Fairmudge, Fund Manager. Good morning.
Good morning, Alex, and thank you very much. Good morning, ladies and gentlemen. Thank you for your time this morning. Conscious that it is Monday, so you're all very busy. So the format very much as we usually do. So a canter through some of the backdrop of the trust, what we're trying to achieve, how we've done, a bit about performance. Excuse me, year to date, and then very much get into how we've been doing more recently, and what we think is going to happen in the next 6 months. And obviously we've got a very large event coming up in less than 2 weeks now, in the form of the budget. So apologies to those of you who heard me mention quite a lot of these slides before, but just bear with me, because obviously we've got a mixture of existing investors, potential investors, and people who are having an introduction to the trust here today. So in terms of what do we do at Thames River Capital, the trust is the mothership, but we actually run about 2.2 billion in total. The majority is still pan-Europe, but increasingly a number of global mandates, and in some cases some US only as well. We've just won last week. We just won a $300 million mandate, which we're pleased about. Okay, in terms of the team, a reminder, we're a big team of 12, and that includes a team of 12 in London, plus an analyst we can tap into in the US, Brent Dilts. But as you will notice, to remind those of you who are new to this presentation, a lot of the team have worked with me and with each other for a very long time. Alban Lanier, who's the Deputy Fund Manager, been with me for 17 years. George Gay, who looks after our physical real estate, 20 years. Joe Elliott, our Finance Director, 20 years, etc., etc. So a long-standing team, and Paul Gorry, our UK and Nordics analyst, he's been with us for 7. In terms of just pulling together some basic facts about the trust, we can own physical property up to 15%. We're currently at 5.5. That is almost an all-time low, and it reflects two things. One, the transition out of a large asset, which we'd finished all the asset management on, which is the Colonnades in Bayswater. But more importantly, rather than recycling that capital back into the physical commercial assets in the UK, we felt that there was better value in the equity market over the last 6 months, and that is, or 12 months, that has come to pass. Gearing, whilst our legal maximum is 25%, we generally won't go over 20. We're currently at 17, or if actually this is live, we're at nearly at 18. Bear in mind that in Q3 2008, we were a quarter before Lehman's went down. We were 20% cash. So essentially 20% cash, most bearish, 20% geared, most bullish. Therefore, we are clearly extremely bullish, and that's what we want to talk to you about today. Results for the previous financial year to the end of March on the left-hand side, and then for the first 7 months excuse me, of the new financial year on the right-hand side. So, and we will be publishing our half-year results to the end of September, which essentially you knock off 1% of all these numbers. That will be, gives you, where we were at the half year, and results will be out at the back end of next week. Okay, performance. You've seen the slide before. I'll go past it. It's basically just our relative performance versus the benchmark, which we're clearly proud of. But the past is no promise or guarantee as to the future. Income, crucially important. TR obviously originally stands for Touche Remnant, going way back in the day when we were a part of the Henderson stable. We then moved to Thames River Capital, and we told everybody that it then stood for Thames River. And of course, we're now part of Columbia Threadneedle, albeit Thames River is still an entity of which we are principals in, and it is essentially a joint venture between us and Columbia. So we now say that TR stands for total return, and that's absolutely genuine, because income, a mix of both income and capital growth, is what we're trying to achieve here. As you can see, the dividend has grown every year since 1996, bar 1 year, and that was 9-10. And you will also, sharp-eyed, will notice that we have been drawing on reserves for the last couple of years. Reserves now equal about 50% of our full year, 1 year's payout. And we may need to draw on them a little bit more, but it helps essentially smooth the dividend payment. So in the good years, we put some of reserves away in store, and then we need them when we need them, etc. But more of that a bit later. I think real estate at the moment very much seen as, which is what it is, which is at the the value end of the equity trade. We are, the world is having its head turned by growth, and particularly by the Mag 7, etc. But a real reminder that there are so many parts of our world that are enjoying structural growth. Residential, I think everybody knows how undersupplied we are here in Europe. Data centers, crucial growing part of our environment. Industrial, e-commerce, logistics, absolutely booming. A lot of I would say booming. Rates have slowed, but still very positive. And then healthcare, be it primary healthcare or elderly healthcare or social care, social housing, all of which is proving to be growth parts of the market for obvious reasons. And then I think this is quite a useful slide, because it sort of breaks down global real estate equities into their constituent subsectors. And I think many, the area that we are most concerned about is the office market, across, with some exceptions, which we'll talk about a bit later on. But, when you look at equities, real estate equities globally, offices are, as you can see here, 5% of market share. In Europe, on a Europe only basis, slightly more, probably closer to 7%, but really it's still, compared to the headlines it gets, because all journalists like to ambulance chase, it's almost you can avoid these markets if you so wish. Okay, so just a couple of background slides here, just to remind you about how on the left hand side this is unlevered income, returns from unlevered income real estate in the UK. So income and capital return. You've seen this many times before, and what it's really showing is as how the capital account swings from positive to negative, and those two very deep drawdowns of the early 90s and then of the GFC. First one being caused by the overdevelopment of the late 80s. The GFC was all about not only the very dramatic change in the cost of debt, but crucially the lack of availability of debt. And then more recently, we've had a dramatic change in the cost of debt, but plenty of availability. Now we find ourselves in an environment where that cost of debt is falling. The availability is high. We're seeing competition amongst lenders. We're seeing margins coming down, as you can see from these Z spreads on this slide, and the Eurobond, the yield to maturities. So that's all very encouraging. Going back one slide, then to see how this is reflected in the equity market. This is crucially important. So what I'm showing you here is some of our key metrics that we're using, and for us, The NAV itself is less important because NAVs are backward looking. They're also a valuer's interpretation of market data. There's nothing, it's not like equities where they're, a wider equity market where they're pricing every minute of every hour of every day. So you've got to be careful with those, take those with a pinch of salt. But what you can't, well, what is factual, of course, is your earnings yield and your cash income that you're receiving, your average cost of debt and your average LTV. What you will see here relative to private property companies, public property companies are very, very conservative about their levels of leverage. And then when you look on the right-hand side where we're trading compared to history on a discount to asset value, it's not a question whether you believe the asset value or not. It's just the fact that when you look at it on a relative to previous cycles, you'll see that we're looking, this is reflecting the lack of popularity of the sector. So what we're seeing is a real market opportunity. And then the last leg of the stool, we've talked about this before. This is, we are seeing increasing levels of consolidation. So these are small property companies merging. We've been very, very active in this space. And then sometimes we unfortunately, private equity comes steaming in. And in the case of PHP Assura, we were able to see off KKR and to merge PHP and Assura into a proper, decent 4.5 billion market cap property company. But sometimes, or the listed market just doesn't want the assets. In the case of Warehouse REIT, that was acquired by Blackstone. We were happy to wave goodbye to that. We didn't like the assets. We didn't like the management. And happy to expand on any of that if anybody wants to in particular. And then we, the Unite acquiring Empiric, we were not pro that transaction. We sold a lot of shares when that was announced, and the share price has declined on the back of that, plus its results. Okay, diversification, fairly obvious. And then, the history of performance of real estate equities, clearly 2022, our annus horribilis, and then you had these sort of various false dawns of recovery, but we really feel that this time we are moving up to, the market is understanding the opportunity, which is, businesses that have low leverage, have access to debt, cost of debt falling, where you own the right real estate, there is rental growth, there is a shortage of supply, and there are some really interesting market opportunities. Okay, and then to remind ourselves that this is just an illustration of how real estate's performed versus wider equities following the peak in interest rate cycle in the previous 4 cycles. All happened for different reasons, etc. But just as you would suspect, real estate does well when the cost of money is coming down. Same way in 2022 we did so badly because the cost of money rose so dramatically. Right, getting into a bit more about what we've been busy getting up to. There are 3 slides here covering Q1, 2, and 3. So we'll just touch on a few things. On the left-hand side, if the arrow is green and heading up, it means we acquired more of it. If the arrow is going down, then we sold more of it. And where it's going both ways is because within that period we had a rotation in and out and back in potentially. You'll notice data centers, we took profits in Merlin and then we subsequently bought back into it at a lower price. Higher beta names at the bottom. This was when we were taking risk off the table. There are 2 ways for us to take risk off the table. One is just to reduce leverage overall and move into reduce gearing, potentially all the way into cash. The other is to sell businesses that we think are going to have a higher propensity to react poorly to wider global issues, and you will notice that in there quite a lot of names like Catena and Sagax. These are Swedish property companies that tend to be more highly leveraged. And then you will notice M&A activism, Urban Logistics REIT, Warehouse REIT, Assura. Having been less than complimentary about Warehouse REIT, that didn't stop me from realizing that this business was likely to be taken private, and therefore there's nothing wrong with us buying the shares as a short-term tactical trade. to pick up basis points of performance. And then in Q2, things to call out here, again, adding to industrials on weakness, management change, social housing REIT, which was known as Triple Point, and Hammerson both saw management change, so we were acquiring ahead of that. UK majors switching out of lands into British, and then you'll see at the bottom that sale of Unite that I talked about, and others that we are happy to mention, and then coming out of some of those Swedish diversified names as those higher beta plays. European shopping centres have been a massively strong performer for us. It's been a great run, and we just took a little bit of profit out of both Eurocommercial and Klépierre. And then in Q3, here we're buying back into data centres through both Merlin and Tritax Big Box. Tritax Big Box has a very large scheme close to Slough, sort of almost adjacent to Seagrove's assets, and that's with the Secretary of State for the Environment for determination at the moment. So we hope they get that. That would be great. And then we bought more of Switzerland, which is generally a safe haven, but interest rates essentially going back to zero there. And then you will see in the M&A activism part, where we sold out of PRS REIT once the bid had been announced. We acquired shares in Big Yellow both before we have been acquiring, buying back into self-storage, and then we found that we were benefited from acquiring some more shares because this company looks like it's in play. And Blackstone have been granted an extension to their put up or shut up into December, so going past the budget date. And then again, Warehouse REIT, we took our profits there. We have bought more residential exposure, and that's quite important. TAG in Germany, which has 25% of its assets in Poland. We're very optimistic about what's going on in Poland. And then IRES, where there's been a change in legislation to take the cap, hopefully to remove the cap on rental growth, which is basically stymieing development. As you all know, if you over-regulate residential markets, that's all very beneficial for those lucky people who own a flat and where rents are then sub open market, they're below market value. But for everyone else, they're busily waiting in a queue because no developer is going to build more flats if those rents are going to be capped. It just becomes uneconomic. And the Irish government have realised that they're getting no development in Dublin as a consequence. They need to change the rules. Seagrow, we've been taking chips off the table here. We can talk about that a bit later. There might be some questions on it. And we've been adding to WDP and CTP actually in continental Europe. This is where we're seeing the benefits of Asian businesses shortening their supply chains, bringing more last mile closer to the final customer, and for completion, the final sticking together of bits and pieces, and lots of storing parts here in Europe for final assembly. And then finally took profits in Shaftesbury Capital, the owners of Covent Garden and parts of Chinatown, etc. So it's good business, but we think that the values have moved too far. Okay, reminder: we are more continental Europe than we are the UK. Don't worry too much about our geographical positioning. It's all very much a question of bottom up. Here on the left-hand side, we split our world into these 26 buckets. And I've talked about these in the past. It's where companies sit, whether we can put them into the same group. Not all of them sit comfortably in each one because quite all of them are diversified names. But where we think that the same sort of macro drivers around deglobalization, etc., all logistics, industrial names go into the same pot. But where we see it's very local, so you'll see the separation between London retail, which is all about tourism, versus UK national, which is about the UK more regionally, versus Europe, where the European shopping centres, which are very different because we have lower levels of online purchasing and also supermarkets anchored by hypermarkets. Sorry, shopping centres anchored by hypermarkets, not anchored by department stores. And on the right-hand side, this is our relative positioning. So you need to be in a subsector that we think has got growth prospects, but more importantly, how is that reflected in the price of the underlying company? So in some cases, we're very positive about the underlying market, but it's just the fact that it's all reflected in share prices. Okay, and then largest positions versus the benchmark, both overweight and underweight. That's just some statements of fact. And then the final ones that we talked about many times in the past, discussed this at the AGM, shrink or merge, standing still no longer an option. This is all about the fact that so many of these names, particularly in the UK, are owned by wealth managers that themselves have consolidated, and they have no interest in businesses with market caps of 2, 3, 4, even 500 million, and they absolutely want them to merge into billion plus players. In some cases, we're going to see these ending up being privatized with the likes of PRS REIT, and then both Life Science REIT and Aberdeen European Logistics Income have both announced wind-ups over spread over time. But it's which is I think it's always a disappointing route to go, but it reflects the fact that certainly in the case of Life Science REIT, a very disparate group of assets, very sort of uncoordinated purchasing profile. They just got too much money was raised too quickly. They got into development, standing investments, all sorts of things which haven't proved to be very successful. And then looking at our physical portfolio, a reminder, Bayswater was the big asset that we sold, sort of £33 million. And then when we look at what else we own, as you can see, it's unashamedly in that logistics and industrial space. In the case of Wandsworth, this is a fantastic scheme for that's Wandsworth Town Railway Station, top right-hand corner, River Thames, above the picture. And here we are on a rolling refurbishment. Phase 1, we've let two units to a high-end female athleisure wear business, rents over £50 per foot. We're now doing phase 2, which is 3 units. We've let 1, again, rents over £55 per foot. And we've got 2 more that are on the market, and when we will then roll out the rest of them. In the meantime, the vast majority of the scheme is let. It's just let on short-term leases while we roll through to the refurbishment. You may be amazed by the level of those rents. You didn't get it. You didn't mishear it when I said £55 per foot. But remember, these are relatively small units, 3,000 square feet. And actually, but they are, there's so little what we call ultra-urban industrial space that if you want to be this close, and here we are very unusual to have an industrial estate that's so connected with a mainline railway station literally next door, and then plenty of amenity. We've got a Joe and the Juice, we've got restaurants, we've got cafes, because just south of this picture is the Tonsleys, a well-heeled, wealthy Wandsworth neighbourhood, residential neighbourhood. And then responsible investing. This is really just to remind you, we do absolutely everything we can on our buildings. Everything's green leases. We're putting solar panels where we can. And in the case of Wandsworth Food Bank, we rotate them through. If we have a vacant unit, they are welcome to use it, which they are at the moment. And then sort of to pull it all together before we get into some Q&A, and I'm going to actually be on the button for my 25 minutes of sort of formal speaking. Just to pull everything together, we have this positive interest rate trajectory for us. The short end of the curve is clearly coming down. There are more cuts coming. The long end, obviously, is particularly in the UK, is much more subject to our government's behaviour, but we are seeing stability and dropping rates across Europe. Equity prices remain heavily discounted. The analogy I've been using is that in your portfolio, your little bit that you hold in real estate, equities is very much the designated driver at the party. We've the steady Eddie delivering you, as we have in the first 7 months of our financial year, 13%. But it's the tech bros at the bar who are buying everyone drinks and probably getting into a situation of excess. And at some point, everyone's going to go, please, can we go home? Where's the designated driver? Let's have a bit more of that, because the tech bros have been sick in the loo or whatever. More potential M&A. I think this is really another key driver. If listed real estate globally is only about 6% of all institutional grade real estate, so we're very much price takers, not price makers. And that figure is one percentage point lower in Europe, and i.e. the US REIT market is bigger than the European relative to their market. And if we continue to undervalue our listed companies, then private equity will come along and take it private, and that's more fool us in many respects, but it's been an opportunity for TR Props to make money by picking those companies that we think might get taken out. Opportunistic capital raises on the increase. This is encouraging, healthy sign. This is listed companies taking advantage of changes in structural shifting away from defined benefit pension schemes, for example, that aren't owning real estate, or you get the border to coast amalgamation that's producing more real estate onto the market in the UK. And then the volatility that we're seeing, be it based on tariffs or geopolitical risk or what's going on, and in terms of the sell-offs we've had last week in the US, just a sort of inkling of what the future might hold. And then, as I said, real estate equity is offering that stability and resilience, which to us is crucial. And then on the appendix, just a couple of slides about which you'll be able to see on the pack. Where we bought and sold Urban Logistics REIT. This is on the left-hand side. We started to think that there might be an opportunity here. Then we realised that it was probably management were going to dig their heels in. So we sold out, wandered along, and then came back into it when we realised that there was genuine desire from other companies to come and take this business either private or amalgamate with it, and LondonMetric acquired that business, and then not a similar situation with Warehouse REIT. Okay, right. I think that is the end of the formal part of the presentation. Do hope we've got some questions. So back to you. Thank you.
Yes, thanks, Marcus. It's Peter Brown here from the team. We have quite a few single stock questions. I'll try and merge a couple together if possible. LondonMetric recently disclosed a larger position in SREI, which is Schroeder Real Estate. I believe you are also a large shareholder. What is your latest on this position? And another question on that is shrink or merge, any views on SREI and the stake LondonMetric has bought?
Yes, great question. I think our view remains that we want to keep these assets in the public domain, and whether SREI on its own is too small, so whether it becomes part of LondonMetric or whether it became part of another listed company, I'm potentially relatively agnostic about. We will sort of see how things turn out. There are, LondonMetric is a very big business now, and sort of swallowing SREI, if that was to come to pass, would have an impact on LondonMetric, but potentially not that great an impact. However, I think it is encouraging to see London Metric, step up and make their intentions known and give themselves, give the market that visibility. So yeah, that is our view. Having said that, if we were to cast our minds back a few months, if you'd asked me the question before London Metric declared their interest, I would have said I would like to see mergers of some of the smaller diversified names, really coming together. And of course, everyone's going to say, "Oh, but my portfolio is so different from somebody else's." But they're different to an extent. But the fact of the matter is, you can really pull economies of scale by merging, a couple of 500 million of gross assets, or a couple of 300 million of market cap, 250 million market cap businesses. You get some tremendous economies of scale through that. And whilst we didn't own Custodian or Aberdeen Property Income, I did feel for Custodian because I felt that they are a good business, and they would have benefited from taking on those API assets, but it wasn't to be. And then, of course, the API assets were snapped up by a Goldman Sachs backed vehicle, Golden Tree. So that was sort of a shame. And I think that not quite sure why API shareholders. I think it sounds like there were only a couple who were motivated for that rapid sale rather than the merger with Custodian. So like the idea of some of these smaller names being put together. We're big holders of Picton. We'd like to see Picton bigger as well.
And on that point, we've got a question come in. Is the trust able to be more actively encouraged in mergers and tie-ups to drive shareholder return? What can you do for that?
Yeah, it's a very nice question because it allows me to give a sort of wholesome answer. I've been actually for many years, as I should go back to, I'm just going to kick back to the M&A slide. I've been talking to management teams and to boards, and we have been instrumental behind the scenes. So for somebody who is, in our little world, people will consider me to be highly vocal. It may come as some surprise that, it wasn't until we got to Urban Logistics REIT and the complete nonsense of the proposed internalisation, which would have cost shareholders £18 million, which they didn't need to pay. And that led to us joining with Harwood and Waverton and putting forward a resolution for the EGM for the removal of the chairman and some senior independent directors, and then that we were able to withdraw that resolution because London Metric galloped over the horizon and slightly saved the board's blushes by bidding for the company. But prior to that, all my discussions with boards have been behind the scenes, and there have been many. And we've made our views absolutely known to lots of management and to boards. Sometimes it's very difficult, particularly on consolidation. You start with 2 chairmen and 2 chief execs, and then you end up with 1 chairman or 1 chair and 1 chief exec. And that's not always, a comfortable position for everybody. Sometimes it's a natural evolution, and there are people stepping down. In the case of SREI, excuse me, the manager, the de facto CEO, Nick Montgomery, has been promoted to global head of real estate in Schroders. So that sort of chief exec seat is currently vacant. I know the deputy fund manager has stepped in on a temporary basis. So it's a sort of easier situation when there is a natural spot. But I'm very happy to talk off the record about where we've actually made what we consider to be serious inroads, and that's because TR Props is a fantastic vehicle. As a permanent capital vehicle, it does allow me to take quite large positions in small companies, and therefore to be a voice of at least influence, but also to be able to reflect to boards, the views of, it might be my personal views, but it's generally the views of institutional holders. And then I encourage chairs to go and speak to other shareholders who may or may not have the time, because it's maybe a relatively small part of their portfolio. But and that has certainly been helpful. And the chairman of one business that was taken over was very nice enough to come and see me the other day to say, Marcus, you were important in helping me form some ideas about what we should be doing and talking to other shareholders. So yeah, we are very, very much active. The only thing to close on is there are now fewer candidates for that activity. We have only a handful now of what I consider these subscale businesses, and the rest we just want to help them grow as quickly as possible.
Thanks. Moving on, what do you think of the recent developments at Supermarket Income REIT, the expansion into France and UK convenience grocery retail, and the recent joint venture with Blue Owl, which is known for its triple net strategy, whatever that is?
Yeah, so the Blue Owl deal, I think, is a very good one. Essentially, it's by selling assets into the joint venture, particularly mature, long income assets at a very good price. That has given management some more firepower and allowed them to go and buy slightly higher yielding assets. I think the French strategy is fine to an extent. I think it should be a part of the portfolio, almost like a satellite to the core, but should not become anything more than that. It is my view. I can understand why they've done it. It is higher yielding. They can borrow much more cheaply in euros, so it is earnings accretive. But they also appreciate that there are risks come with that. They are using good quality local knowledge. They've assured me for that. For the UK convenience, I think it's a great part of the market. I think it is. We just have to accept that no one's going to build another 80 or 90,000 foot food store or 120,000 foot. It's not going to be necessary. You've got to be on the survivor sites. You've got to be on the sites which can form part of the click and collect and click and deliver format, as well as providing the full offer. So that all makes total sense. And I would rather they went into convenience than possibly bought some of potentially the weaker operators. So we're happy with the strategy, and I think the new management team are doing a very good job. And Rob Abraham is to be applauded for what he's done. He's relatively young, but he's been in the business for a long time, and I think he's doing a cracking job.
Moving thick and fast. In the latest fact sheet, you mentioned that you have been adding to Tritax Big Box. What do you think of the recent developments there, diversifying away from big boxes into smaller logistic assets and their plans in the data center world? Is it a healthy development or style drift?
Great question. I think the answer is I'm very happy for them to be engaged in more than just big boxes. I think that the ability to play the valuation cycle is useful one for on multi-let industrial. It does add a skill set. It does add to cost. I'm less comfortable with the way they've gone about it in terms of the UKCM transaction, because there was a lot of non-box assets, be it big or small boxes, and they have had to exit out of a lot of assets that were not core or even satellite, and that comes with some risk. They have managed to do a lot of it, but not all of it. The Blackstone acquisition, I think, is smart from both sides, particularly for Big Box remains an externally managed vehicle at the moment, and it is by far and away the only externally managed vehicle globally that of that size. I can understand why REITs are, when they start, they often are externally managed because they don't, they almost unable to support themselves, and that's why management teams are doing other things as well alongside growing the REIT. So it made total sense for Tritax to be externally managed for a long time. But I think we must, when we look at the new chairman coming in next year or year after, that must be at the top of his list of, or her list of things to look at, because I think the Blackstone deal does look like a sort of carbohydrate. They're sort of bulking up on assets, and that of course helps the fees for Tritax / it's Aberdeen, who own 60%, nearly 80% of Tritax. The bit that we think is really, really smart is this data center development program, and we think they've got, and this is to an extent a skill that sits outside of Tritax Big Box, but sits within Tritax Management Limited. So here I'm arguing against myself in terms of, is that a skill that would normally be inside if this was an internally managed REIT? And one might argue that's something that is a justification for being externally managed at this point in the development of this company. But I think if they can, we're watching very closely, as I said, to whether we get the consent, whether they get the consent for Manor Farm, which is the Slough site, and that will be hugely beneficial. And then we hope that because they have built such knowledge about data centers, that there should be other things coming down the pipe. We don't know about them yet, but it's something that it's been one of the drivers for us, is hoping that is the case, and where we see potentially a point of difference between Tritax and SEGRO.
Moving away from single stocks for the minute, this is about the trust in general. Asked at the last AGM about the TR Property dividend, has the board given more thought to moving towards a stable quarterly dividend? Now, we did ask about this, didn't we? And I think it was to do with costs associated with paying roughly 4p per quarter rather than 8p semi-annually. Is that right, Marcus? Can you remember?
Yes, that is correct. And of course, the other issue we have is our income is lumpy. It doesn't fall naturally into the 4 quarters. It's not like a supermarket income REIT or where you absolutely know, because you've got these very long leases, and you know exactly what your income's going to be looking out. We of course don't know, and in fact we have been surprised to the upside when, as in, companies have been increasing their dividends higher than our expectation in quite a number of instances. But that doesn't mean that it's entirely predictable. And we therefore think that having a half year and a full year remains the right approach.
SEGRO used to be a stable position in the top 10 of your portfolio. What is your current view? Why are you not a larger holder anymore? Have the business fundamentals changed in your opinion?
Yeah, lovely question. I mean, essentially it's twofold. One, you've heard me talk about how we think the opportunity set in Tritax Big Box is probably greater than SEGRO at the moment in a UK context. In a European context, we have plenty of other players who we can invest in, large ones like WDP and CTP, and then smaller businesses like Argan in France and Montea in Belgium. And really, this is about the fact that we prefer to be invested with those deepest invested in the local market. So these tends to be local players. SEGRO, as a pan-European player, does have some market exposure which we consider to be suboptimal. So they're too small in one or two of these regional markets. And as a result, it does make it's very expensive to run SEGRO. It never ceases to amaze me how much it costs to run that business. And as a result, the earnings yield from us, from SEGRO, in my view, is suboptimal. And then the last sort of, not so much criticism, but observation, is that the rents have been, they've done such a tremendous job in their London market. So this is particularly, Park Royal and the Slough Trading Estate, as well as some of their East London assets. There's just been a slowdown in rental growth and a bit of an increase in vacancy. And stock markets they just don't like slowing growth rates. Rates are not negative. Excuse me, they're not negative, but they have been slowing quite significantly. And you've seen that share price come off from the peak of 14 quid down to 7. So, but then everything else has been impacted as well. So for us, we're still confident about the absolute growth in industrial logistics in the UK and Europe. We just think the rate of growth is slowing in certain subsectors, submarkets. We can get cheaper, higher yielding, in our view, better exposure in some European markets through European locals. And then in the UK, it's been sort of playing that big box, Tritax and potential data center thematic, which we think is offers a greater opportunity than SEGRO at the moment.
You made a quick reference to your position in the US, which the questioner says I did not understand and does not appear in the position changes slides. Can you make a few comments on your US aims? It would be appreciated.
Yeah, no, sorry if I wasn't clear. It was merely to point out, going all the way back to, I think it's sort of helpful for investors to understand, what we do at Thames River Capital beyond TR Property. And the reason that is because I have all these people who are supporting me and supporting the trust. For example, you'll see on the far right-hand side, property growth and income. So we have 2 full-time surveyors, George Gay and Hannah Corney, and they're looking after assets, physical assets, not only in TR Props, but also in property growth and income, which is our open-ended daily dealing hybrid vehicle. So it's about 70% equities, 30% physical. I launched this in 2005 with the strapline, open-ended daily dealing in physical property are 6 words that shouldn't be in the same sentence. And we've seen over the last 20 years the disaster of the PAIF and the ridiculous idea that you can have a portfolio that's 100% physical property and also offer daily liquidity. I mean, it's a nonsense. And the sadness is that everyone knew it was a nonsense, but they carried on. And then, of course, when the moment everybody wanted their money back, the exit turned into a cat flap and things got shuttered and gated. We haven't. PGI has remained open, has never closed for liquidity reasons. But my point here is the symbiotic relationship across owning both physical property in TR and property growth and income. As far as our international, so ex-Europe, so our Asia or our US strategies, we are running those with other funds, but all the time it's building our knowledge. We've now been running global real estate equities in this team now for 13 years. And there may at some point come a point where the board of TR Property say, well, they have already said, Marcus, if you want to have some exposure to the US, you can, relatively modest. But we've chosen not to date. But there may come a point in the future where, and that will be a conversation over a long time with shareholders, and there's no desire to do that at the moment, but I'm just making sure that everybody understands what we do in the team. And that's so sorry if there was any confusion around that. So just to be clear, TR Property remains pan-European only.
Thank you. When you talk about UK diversifieds, what specifically do you hold in this sector?
Yes, that's a good question. And of course, I think it's a reminder that we really, in the UK, lots of companies are themselves diversified. and therefore, we have to almost create a bucket for them on their own. So we separate, obviously diversified names, land securities and British land, we separate those, and they are in our UK majors, because actually they are generally driven by very large macro calls. When we find that when investors want to get into the sector or want to get out of the sector, as generalist investors in a hurry, then they're obviously going for the larger names. So that, of course, is Segro, Lands, British. So into the diversified bucket will be all those businesses like Picton, SREI. We've talked about. We can choose whether London Metric sits in that diversified bucket or should be in the industrial, given that it's 60% industrial. We've chosen to put it in the into the diversified bucket. And so that those are the major names that we own in that group. But you would find, the little tiddlers like AEW, Custodian, they would be in there as well.
Next is requires your crystal ball a little bit. Any subsectors you feel are more exposed to potential budget risk next week? And I'll merge it with, what is your view on long-term UK inflation? Do you see it fall into the Bank of England's 2% target? And what does this mean for UK interest rates over the next 5 years?
Good questions. Let's deal with the inflation one first. I think that unless this government is extremely careful, we do see unemployment creeping up. I think that they have woefully either underestimated and are therefore, if they don't do anything about it, choosing to ignore the massive impact of the combination of increasing employers' NI, but crucially dropping the threshold at which it is paid down to £5,000, and the impact that has had on many small businesses or even medium-sized businesses. And for a government that's about working people, and let's not get into a debate about defining that, it's just astonishing that you would destroy businesses that would or destroy opportunities for businesses to expand because they just can't afford it anymore. So that's your first point. The second is the impact of Brexit on economic growth, productivity, exporting is still being felt, and I think that it's very hard to see engines of growth unless this government pulls some rabbits out of hats in a couple of weeks' time, and therefore I do see growth slowing and inflation coming down. Now that will obviously be a function of sterling and the cost of imports. That's very important. But yeah, I think we are going to find the short end of the curve coming down, and then the question is, does the long end follow? And that's going to be much more about the price at which the world is prepared to lend the little old UK money. As far as the budget is concerned, we've already got things in train that some of our sectors are going to benefit from, which is obviously the change in rates and the rating liabilities, which are obviously going to go up for those who've experienced lots of rental growth through industrial and logistics, and then the rates bill is going to continue to come down for retail, particularly for high street retail. I think the impact of the budget on commercial property won't less be that great compared to the impact on residential. I think that is where she is going to target. You've all read endless reams about it, and I think that taxation of the top 5 or 6% of residential dwellings, so that will be bands F, G, and H of council tax, is highly likely. I think it would be a great thing to lift many more properties out of these very high levels of stamp duty, to try and put some momentum back into the market. But structurally, over long periods of time, we've got to stop selling social housing to incumbent tenants under right to buy, because unless the local authority is going to build more of it, so it's and that is it is a problem. And the Renters' Rights Bill will drive small-time landlords to sell because there's too much risk, and that will then potentially create the opportunity for more institutionalization of PRS, but seems unlikely. So yeah, for us, it's the impact would only be felt on the listed space around the likes of Granger. PRS REIT is being taken private, so for us it's much more about what happens to consumer behavior and impact on spending inside our inside commercial property, particularly retail, leisure, hotels, restaurants, etc.
Great, and we're coming up to the hour, so I'll make this the last question. If we haven't got to your questions, we will answer them after the event in writing. You can see the answers on the Investor Meet Company website. But we'll finish with 3 combined. What's the outlook for Phoenix Spree and potential timescale? Does Marcus still see Phoenix Spree as a value realization opportunity? And is he comfortable with the progress being made on deleveraging and returning capital to shareholders? And Marcus, are you becoming more or bullish or bearish on German residential?
Okay, nice ones to finish on. So Phoenix Spree, the last call we had with management, they were uncharacteristically bullish. And what I mean by that is it's been a long, hard road for those investors who are familiar with this business. They essentially have moved to a wind down process, but they own some very unusual assets, in as much as these are prime Berlin apartments which can be split into condos, i.e. you take a block of 20 flats, and as the tenants move out and they decide to upsize, downsize, move to the country or whatever, and the flats become empty, if you have the ability to do this, which Phoenix Spree do in 80% of their portfolio, 80, rather than be forced to let to another tenant on a regulated rent, you can tart the flat up and sell it in the open market. And there is a huge shortage of flats for sale, and that is what the business is now doing. The game changer for us was the sale of a large portfolio to Spielberg Partners Group, which allowed them to pay down enough of the debt to get into a situation where, when they refi the debt, which is due to be, the refinancing is due to be announced anytime between now and Christmas, that will enable them to accelerate the return of capital to investors. So it does take time to sell these apartments because you have got to wait. The churn rate is only about 7%, so you've got to wait for the tenant to leave, then you can do them up. But I'm confident that once this new debt is in place towards the end of this year, and they can begin at least to give us a pathway to a return of capital, then not only will that be a fillip to the share price, because it's trading at a very healthy 45+% discount to its asset value, that you have an opportunity potentially for private capital to come in and say, well, look, there's money on the table here. The equity market is undervaluing the business, as it always does. and was an opportunity to take it private. So I think that's the most likely outcome over a 2-year horizon. But in the short run, I'm hopeful that we'll get some positive news this side of Christmas. In terms of the wider German residential, yes, it is certainly, it's been a long road where there's been very little trading of large portfolios. The asset class is very secure, and essentially for the regulated rents, broadly index linked. So you've got essentially an index linked long duration asset, and therefore as long-term rates in continental Europe continue to come down, the sector will return to being popular. However, is the current nature of some of the listed companies, particularly the very large ones like Vonovia, is that they have a lot of debt that needs refinancing and restructuring. And Vonovia will be welcoming a new chief executive in literally, I think he starts at the end of this month. And we'll see what he decides to do, whether it's a shrink to grow strategy or how he's going to deal with it. So in summary, I'm attracted to the asset class now following a restructuring or resetting of pricing. But if I'm totally honest, I'm interested most in Phoenix Spree and TAG because of its opportunity in Poland. And in terms of deployment of capital on a relative basis, I think there are better opportunities for TR Property elsewhere in the pan-European real estate equity sector. If from an absolute point of view, if you're owning these businesses, I'm fairly confident that you're not going to see a lot of negative price movement from here.
Thank you, Marcus, and thank you everyone for tuning in today. We hope you found that very helpful. Marcus, if I can give you 30 seconds to summarize, and then we'll hand back once finished.
Yeah, I think just to remind investors that we're clearly optimistic. This is about the lack of supply of best-in-class space. We're seeing rents rising in so many of our sectors. It's to remind investors about how we are accessing lots of different subsectors. There's no need to own secondary shopping centres or secondary offices, etc. We are seeing some great pockets of value. M&A is there, both consolidation, but also private equity, lots of capital hiding in the wings. And if you got there's one layer of market performance, which is the underlying commercial assets, then the other layer is how is that reflected in share prices, and that's where we see that particular opportunity. TR Props is trading at a 9 discount to its NAV, which I think is wider than one might expect if you were feeling as ebullient as we are. And then what really will help us all will be a bit more of a wobble in the valuations of these technology businesses. I still think these data centers are going to be built. The issue is, what's the return on capital for those who've provided the capital to build them? Remember, we are owning companies that own the land, and therefore those businesses are only going to get built. Those units, those centers are only going to get built if someone is already paid up for them, or taken a lease from a high quality hyperscaler or whatever. So we are not at the risky end of this particular trade, and I think that's quite an interesting take on what is clearly the next revolution, and we want to be part of it. But we want to be part of it on a stable, cash generating end of the game. On that note, thank you very much for listening. Always available to take questions. There is the question box on the TR Property website, so that comes straight to us if you have anything burning, or of course speak to the much nicer Pete Brown. Thank you very much.
That's great, Marcus. Thank you very much indeed for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the board can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of TR Property Investment Trust PLC, we would like to thank you for attending today's presentation, and good morning to you all.